Aloha, welcome back. We're still on Chapter 9, long-lived tangible assets or fixed assets and depreciation. We're going to work on an exercise in this lesson, exercise E9-2. This is on page 434 in the textbook. I'll read a little bit of this problem. Computing and recording a basket purchase and straight line depreciation. The term basket purchase refers to a group of assets that are purchased as a group or in a basket, so to speak. One purchase price that relates to two or more separate assets. And so what we need to do in this type of situation is referred to as a cost allocation. We need to take that lump sum purchase price and allocate it to the various assets being purchased. In this case, I think it's two separate assets. So Bridge City Consulting bought a building and the land on which it is located for $182,000 cash. And so as you can tell, we need to allocate that $182,000 cash to both the building and the land. And of course, you know, we'll always have to have some basis, some reasonable and rational basis that we can use to make that allocation. So in this case, it's just telling us the land is estimated to represent 70% of the purchase price. So this is exercise E9-2. So we have a lump sum purchase price, building and land of $182,000, and the land is estimated to represent 70% of the price, and so the building represents 30% of the price, and so the total would be 100%. So we would allocate this 182,000, 70% to land, 30% to building, and I will simply do the calculations on my calculator. So it's 127.4 for the land, and 54.6 for the building. And of course we'd want to add those two together and make sure they total 182,000. And I should probably do that. And we're okay. Now, reading on, it says the company paid $22,000 for building renovations before it was ready for use. So this would be an example of a capital expenditure. This would be additional costs that have to be spent to make the building ready for use in business. And this is not an allocable item. This is specifically, cost specifically for the building. So we can add that 22,000 to the building and come up with the totals for land and building. So our building would be 76.6. And if we were to add these totals together, our grand total would be 204,000. This is the 182 plus the 22,000. And what is required? First of all, we need to explain how the renovation cost should be accounted for. Again, the renovations would be a capital expenditure, money that needs to be spent to make that asset ready for use in the business. Number two, give the journal entry to record all expenditures. Now, we have two different expenditures. One would be the original expenditure for the 182, and the subsequent expenditure for the 22,000 for the renovation of the building. But we've summarized those two transactions into three totals, and so we could record that transaction in total. And so how we would do that would be to debit the building account for 76.6 and debit the land account for 127.4. And does it say how these assets were purchased? Cash, for cash. And I think we can probably assume that the renovations were also for cash. And so we can credit cash for the total of 204,000. Okay. So that would be the journal entry recorded in number 2. And then in number 3, they're asking us to compute straight line depreciation on the building. Remember, well, I'm not sure if we mentioned that in the previous lesson. Land for accounting purposes, land is considered to have an indefinite useful life, and so land is never depreciated in a business situation. We never depreciate land. So we would depreciate the building. We would use an estimated useful life of 12 years and an estimated residual value of $4,600. And so we can do that calculation here. The building cost is 76.6, and the estimated residual value is $4,600. That's a reduction of cost. And that brings us to we want to check our figures here that we're on target. That brings us to a net depreciable cost of 72,000. And then our estimated useful life is 12 years. Which is actually a little on the short side, I think. Usually buildings are depreciated for much longer periods of time, 20 or 30 or even 40 years. But of course there could be other circumstances involved that dictates the use of a shorter useful life. And so if we divided 72 by 12, That gives us $6,000. And that is our annual depreciation expense, $6,000 per year. So that would be our straight line depreciation at the end of year one. And actually, because it's straight lined, it would be the same amount of depreciation for every year for the next 12 years. And finally, it asks for the book value of the land and building at the end of year two. Book value is a concept that relates to long-term assets. I think we mentioned it in the chapter on adjustments. We just kind of briefly touched on it. Let's see, where can I fit this in? I'm going to fit it in right here in this little space. To get the book value of an asset, and it's actually asking for the book value of the land and the building. If we took the building first, we would take the amount of recorded cost, and I'm just going to show the amounts, not the descriptions for the amounts, because we have such a small space here. The amount of recorded cost for the building is $76,600, and then it's asking for the book value at the end of year two. And so to calculate book value, you take the cost of the asset and you subtract the total depreciation that has been recorded for that asset for the number of years that have gone by. So in this case, we are going to subtract $6,000 per year for 2 years. So we will subtract a total of $12,000. So the book value of the building at the end of year two would be $64,600. And then if we were to add in the land, which costs us $127,400, but is not depreciated, then our total book value would be $192,000. And let's do a quick double check here, and we are okay. And so this would be exercise 9-2. I hope this is helpful, and the concepts are relate to both acquisition of fixed asset or long-lived tangible asset, as well as the depreciation of that asset using straight line depreciation. I hope this has been helpful, and I thank you for your attention.